Okay, so hi everyone, welcome. Let's start with third lecture. Okay, am I audible and visible? एक 2-3 मिनट रुकते हैं till everyone comes. Let's wait till everyone comes for 2-3 minutes. Yes, good evening. Okay, let's start then. Quickly, let's revise whatever we have seen till now. Let's quickly revise whatever we have seen. Simple interest. Simple interest formula is P and I. N is years. I is per annum. Compound interest formula of amount is P into 1 plus I raised to N, where I is interest rate per compounding period, N is number of compounding periods. Okay. Then we saw formula of depreciation, where scrap value can be calculated as cost into 1 minus d raised to n by just changing the formula of compound interest. Fine. Some questions were pending from that exercise. We were going to solve 3-4 questions. Let's solve those and then we'll go to next concept, which is present value, future value, and annuity. Most important concept of the chapter. Fine. So let's come to exercise 4b, page 4.16, question number 6. I think we were trying to solve this, but there was some issue in previous lecture, right? Solve करते हैं. आगे के सब लोग. Let's start. So, population of a town increases every year by 2% of population at the beginning of that year. That means we saw it is 2% compound interest. Number of years by which the total increase of population will be 40% is. Okay. 40% increase means what? If, let's assume, if principal is 100, that is if beginning population is 100, then we want amount, that is closing population, end population, to be 140, 40% increase, right? And we know interest rate is 2% per annum. We have to find number of years. Can try to find this. How? A is equal to P into 1 plus I raised to n. That means 1.4 is equal to 1.02 raised to n. How will we solve this? 1.02 को raise करते रहेंगे. We'll keep raising 1.02 till we get 1.4. Is this properly visible? अगर कुछ lag वगैरह तो बोलो. If there is any lag or something like that, let me know. Fine. So 1.02 raised to around 17 years, you get 1.4. That is, when you press 16 times equal to, you get 1.4. Check whether everyone has got this. If yes, let's see what option is it. 17 years. App means approximately. So 17 years is the correct answer, right? Okay. 16 times equal to Misbah. That means the answer is 17, not 16. Vishwajit correct. Rishuraj correct. Good. Fine. Then, if there is any doubt in this question, let me know. Otherwise, let's go to question number 7. The difference between CI and SI on a certain sum of money invested for 3 years at 6% per annum is 110.16. The principal is what? Okay. Now, we can maybe see a formula for this, but that will be complicated. It is better to solve this by options. Okay, let's go by options. How? They want difference between CI and SI for 3 years. Let's calculate by one for option A. SI for 3 years will be what? P into N into I. Do it fast. 3000 into 6% into 3 years. So SI for this is 540. Whereas CI, how will we calculate CI? Let's calculate amount first. So amount will be 3000, sorry, 1.06 raised to 3 into 3000. So amount will be 3573 minus principal 3000. So interest is 573. So difference is not 110.16. So that is not the answer. Okay. 3700. 3700 into 6% into 3 gives us 666. Whereas 1.06 raised to 3 into 3700, amount is 4406 minus 3700. So principal is 706. Difference is not 110, it is 40. So no, not correct. 12,000. 12,000 into 6% into 3 years, that is 2160 simple interest, and 1.06 raised to 3 into 12,000, so amount is 14,292 minus 12,000, so 2292. Difference is 132. So the D is the correct answer. Still, let's check once. 10,000 into 6% into 3 years is 1800, and compound interest should be 1910.16. So that is correct. Difference is coming to be 110.16. You should be able to solve this fast within 1 minute. Okay. If you try to solve time value of money questions within 1 minute, generally preferably all, then you will get more time for other questions, because around 12 to 16 questions are only on time value of money, right? D is correct, Rishuraj. Anyone else has got D? D is the correct answer. Fine. If yes, let's see 8th also. Let's go to 8. The useful life of a machine is estimated to be 10 years and cost rupees 10,000. Rate of depreciation is 10% per annum. What is scrap value at the end of its life? Scrap value, so we can directly use the formula. Scrap value at the end, that means it is amount. We have principal. So principal into 1 minus D, that is 0.9 raised to N, 10. So we'll get scrap value 0.9 raised to 10 into 10,000. 3486.78, option A. Check whether everyone has got option A. Next, 9th. No, not 9th. 9th we have not seen yet. Let's first go to question number 13. Again, that is similar. Annual birth and death rates per 1000 are 39.4 and 19.4 respectively. The number of years in which population will be doubled, assuming there is no immigration or emigration. Immigration is people coming in, emigration is people going out. There is no immigration or emigration, is how much? Per 1000, births are 39.4 and deaths are 19.4. That means extra people, see, 39.4 people are born, 19.4 people die. That means extra 20 people are there per 1000, right? 20 per 1000. 20 per 1000 means 2%, right? 20 by 1000 is 2%. So 2% is our compound interest rate. We want it to be doubled. Doubled means what? Amount 200 is equal to principal into 1.02 raised to n. Right? 1.02 raised to how much is 2. Right? It is around 35. If you check, at 35 we are getting 1.99988 something, right? So 35 is the correct answer, approximate answer. We can also get it by the trick we saw. 72 by n is interest rate, right? 72 by n is interest rate. So 72 by interest rate will be n. So 72 by 2 gives us 36 years. So 35 is the closest answer which we can take. Obviously, it is better to check because yahan pe, in this case, difference is high. 1 year, entire year, right? Which one, Rishuraj? 20 kaise? Okay. Understand? 39.4 people take birth and 19.4 people die. That means 39.4 minus 19.4. Every year there are extra 20 people created, right? Extra 20 people there in the population every year. That means per 1000, 20 people are added every year. So 20 by 1000 is 2%. Understood? Correct, Vishwajit Sanika. Rishuraj Misbah, Kavya. Let me know if you have understood. 2% interest rate. So 2% interest rate, and we want it to be doubled. So as usual, let's assume amount as 200, double, principal as 100, and find n by taking 2% interest rate. Okay. So if we keep raising 1.02, we get 2 after 35 years, right? Kavya, it will be same as this one, right? Same as question number 6. 34, you are getting 34, that means the answer is 35. Vaibhavi, you might be pressing equal to 34 times, check. After 2%, Kavya, have you understood what to do? Double amount, principal, 1 plus I raised to n, that's all. Got it? Still not? Okay, let's see again. Every 1000 people, 39.4 people are born. 19.4 people die. That means how many extra people are created? 39.4 new people are added, 19.4 people die. That means, can I say 20 extra people are added? 20 people are added every 1000. That means 2% people are added, and population always increases in compound interest because it will be 2% of starting amount. So we want amount to be doubled. How will we get amount to be doubled? Let's assume principal is 100, amount as 200, and as usual amount is P into 1 plus I raised to n. Solve it for n. Got it? Good. Miss Ba, let me know if you have got this. Okay, 35, correct, good. Fine. Okay, good, correct. Now clear, good, fine. Now let's see two concepts which are related to simple interest as well as compound interest. Something called as effective rate of interest. Effective rate of interest or effective annual rate. Effective annual rate. Understand what is effective rate of interest or effective annual rate carefully. Let's say you have two options to invest. What two options to invest? Let's say one option is you can invest rupees 10,000 at 6% compound interest, half yearly compounding for 1 year. Can anyone tell me what amount we will get after 1 year? 6% half yearly, 10,000 for 1 year. Check whether everyone has got this. 10609. How? 1.03 because 3% for half year. 1.03 is to 2 because in 1 year there are 2 half years. So n will be 2. I will have to take 3%. Amount will be 10,609. Fine. So it is 6% half yearly compounding. Now let's say you have another option. Same, invest 10,000 at 6.09% simple interest for 1 year. In this case, can you calculate simple interest and then amount? In this case, can you try? Simple interest will be P into N into I. So that will be 609 rupees. So amount will be P plus SI with, which is still 10,609 rupees. Check. That means simple interest and compound interest are same in this example. That means, can I say 6% compound interest half yearly compounding is same as equivalent to 6.09% simple interest? Tell me if this is correct. Tell me if you understood this. This is giving us same amount as this. 6% half yearly compounding is giving us same amount as 6.09% yearly compounding. Right? Now understand from a layman's point of view, that is someone who does not know this time value of money and everything. कुछ friends है आपके who are not in commerce, maybe जिनको पता नहीं है. Will they understand 6% half yearly compounding and everything? Will it be easy to understand? Or will this be easy to understand, simple interest? Which one will be easier to understand, compound interest or simple interest? For a person who does not know anything about commerce or time value of money or maths, this will be easier, right? Understanding simple interest will be easier. That is why we sometimes express compound interest using simple interest rate, which is called as effective annual rate. Effective annual rate is what? Expressing compound interest rate using simple interest. Okay, expressing compound interest rate using simple interest terms. Simple interest के terms में compound interest express करना. That is called as effective rate of interest. We can put this in formula directly. You might know the formula. What is effective rate formula? 1 plus I raised to n minus 1 for 1 year. Okay, 1 year के लिए आपको n and I लेना है and 1 plus I raised to n minus 1 करना है. 1 plus I raised to n minus 1 you have to do by taking 1 year. That is, in our current case, our compound interest was what? 6% compounded half yearly. Right? So how do we convert to effective rate? 1 plus I, so 1.03 because it is half yearly, raised to n. In 1 year there are 2 half years, minus 1. Check 1.03 raised to n minus 1. Is it giving you 6.09%? This is called as effective rate. This is the same answer that we got here, 6.09%. Correct. So 6.09% is the effective rate corresponding to actual rate. If any doubt, let me know. Otherwise, let's see one more example. Let's say compound interest is 12% per annum, compounded quarterly. Try to find effective rate. Try to find effective rate by yourself. How will you get it? 1 plus I, so 1.0 quarterly means 12 by 4, 3. So 1.03 raised to n, there are 4 quarters in a year. So 1.03 raised to 4. That should give us 12.255 something percent. Check whether everyone has got this. 12.25%, 12.255%. This is the correct answer. That is called as effective rate. So if you want to compare simple interest and compound interest, we'll use this. Sometimes they ask questions like this, understand? Sometimes they ask questions like this, which is better? Correct, Yashodan? So Yashodan, not 12.55, 12.25. Or did I get it wrong? Oh, sorry, it is 12.55. I wrote this 2 extra. 1.03. 12.55 is correct. Fine. Sometimes ask questions like this. Which is better? Which is better? 10% compound interest, monthly compounding, or 10% compound interest, monthly compounding, or let's say 10.5% simple interest. Which one is better? Yes, Vapas. Which one is better? Can you try to find? Is this 10% monthly compounding better, or is 10.5% simple interest better? Let's try. We have to convert this to effective rate first. We cannot compare compound interest and simple interest directly. Let's convert to effective rate. 1 plus I raised to n minus 1. Monthly, that means 10 by 12. So 0.8333%. So that is 1.0083 recurring raised to n minus 1. N is going to be 12. So check whether you are getting 10.47%, whereas this is 10.5%. So this is better. This is giving us more return. Simple interest is giving us more return. Let me know if everyone has got this. It is not same Misbah, check. Compound interest rate is coming to be a bit less than simple interest. Check once. Just a second. Correct, good. Simple interest is better. Fine. If anyone has any doubt, let me know. Otherwise, nahi aaya. Why? 10% monthly. So what is interest rate? 10 by 12 divided by 100 plus 1. So 1.0083 recurring, right? Raised to how many months are there in a year? 12 months minus 1. I hope you are taking 83333 till the end. Otherwise, you will get rounded off answer which will be wrong. Fine. Let me know if you have got it. If yes, let's go to next concept. Now this is the most basic and important concept of time value of money. Aya good, which will be important to us, relevant to you till you go to CA final and even in real life. Something called as PV and FV. Understand carefully. Let's say today at year 0, let's call it year 0. Year 0 means today. You have an opportunity to get rupees 10,000, let's say. But ये friend आपको 10,000 देने वाला है. That friend is going to give you 10,000, but that friend says, no, I cannot give it today. I will give it after 4 years. 1, 2, 3, 4 years. He is going to give it to us after 4 years. So we said, okay, give it after 4 years, no issues. But then I'll charge you 10% compound interest per annum, annual basis. So can anyone tell me what will be amount here? How much will we recover from him? How much will we recover from him? Is it 14,641? That means today, if he gives us, we'll take 10,000 from him. After 4 years, if he gives us, we'll take 14,641 from him. Why? Because of interest, time value of money. Now concentrate very carefully. Can I say this? Today's 10,000 rupees is same as 14,641 rupees after 4 years. आज के 10,000, today's 10,000 is same as 4 साल बाद के 14,000, 4 years after 14,641. Why are they same? Because we are ready to accept 14,461 after 4 years, right? We are ready to accept that much. That means what? It is okay with us. Even if he pays us late, if he pays 14,641 rupees, then we are okay with it. That means for us, हमारे लिए, for us, this and this is same. Today's 10,000 and after 4 years 14,641 is same. This is called as present value of that money, whereas this is called as future value of that money, FV. Present value is today's worth of that money, future value is after 4 years, this for the same amount, how much should we get? For 10,000 rupees, how much should we get after 4 years? That is called as future value. Okay. Now, this process of going from present value to future value, what did we do? We took 10,000 and we did into 1 plus I raised to n, right? Because we assumed this as principal, we assumed this as amount. So we took principal into 1 plus I raised to n. That is process of taking from present to future is called as compounding. And how do we do compounding? By multiplying by 1 plus I raised to n. Similarly then, if we want to come back, what will we have to do? Can anyone tell me? You can type in the comments. For going forward, we are multiplying by 1 plus I raised to n. So to come back, what will we have to do? क्या करना पड़ेगा? To come back, क्या करना पड़ेगा हमें? What will we have to do? Will we have to divide by 1 plus I raised to n? To reverse that effect, we'll have to divide it by 1 plus I raised to n, right? This is called as discounting, that is correct. Let's try to see if it works. How to do it on calculator? Concentrate carefully how to do it on calculator. Take 14,641, 14,641. Divide by 1 plus I is what? 1.1, right? We have to do 14,641 divided by 1.1 raised to 4. So what do you do? 14,641 calculator पे divided by 1.1 and then equal to 4 times. 1, 2, 3, 4. That should give us 10,000 exactly. Check. That should give us 10,000. 14,641 divided by 1.1. 1, 2, 3, 4. That gives us 10,000 rupees. Or calculate this on calculator separately. 1.1 raised to 4. And then add it to memory. And then numerator divided by MRC equal to. This is also okay. This is a bit complicated. This one is simpler. Pressing 4 times equal to is simpler. So for doing discounting, what we do is 14,641 divided by 1.1 equal to. That's all. This is called as conversion from present to future, future to present. And why is this important? Let's understand now. Let's take a question on this concept. If anyone has any doubt up to this, let me know. Otherwise, let's take a question. A bank offers to pay rupees 10 offers to pay. कैसे देखो? Can you repeat? Fine, I'll repeat. Understand? Before going ahead, let's repeat. If anyone is not clear, understand again, because this is the most basic concept of TVM, which will be useful till CA final. PV will treat as principal. Future value will treat as amount. So to go from principal to amount, we'll have to multiply by 1 plus I raised to n. To come back from amount to principal, we'll have to divide by 1 plus I raised to n. Okay. So going from PV to FV is called as compounding. Coming back from FV to PV is called as discounting. Got it, Varghese? Let me know. And while going forward, we can do it on calculator easily. 1.1 raised to 4 into 10,000. That gives us answer. But while coming back to use shortcut, we can do 14,641 divided by 1.1 and then equal to 4 times, because we have to do raised to 4. So 1, 2, 3, 4. That gives us 10,000 again. Okay, let me know if you're clear. And now come to this question. Fine. A bank offers to pay rupees 10,000 after 1 year, rupees 20,000 after 2 years, rupees 25,000 after 3 years, and rupees 20,000 again after 4 years. Bank asks for investment of rupees. Now wait a second, let me create the problem. Just a second. bank asks for rupees 60,000 today. Okay. So what is the question? Bank is saying pay us 60,000 rupees today. After 1 year we'll give you 10,000. After 2 years we'll give you 20,000. After 3 years 25,000, and then after 4 years 20,000. The question is, if you want 10% return, should you invest? Should you invest? The question is, if you want 10% return, should you invest? Let's see how to solve these kind of questions. Concentrate very carefully now. This concept is going to be there in your intermediate also and CA final also and foundation also, obviously. Fine. Now let's try to draw a timeline. This year 0, 1, 2, 3, 4, 5. At year 0, that is today, we have to pay 60,000 rupees. We have to pay 60,000 rupees. So let's write 60,000 negative. Negative figures are generally written in brackets. When we are dealing with financial amounts, generally negative figures are written in brackets. So we have to pay 60,000 today, and we'll get how much? 10, 20, 25, 20. We'll get 10, 20, 25, 20. Nothing on 5th year. Fine. Now the question is, should you invest? Now tell me, ऐसा करेंगे क्या हम? Will we do it like this? Or total of this 4 is how much? Total of this 4 is 10,000 plus 20,000 plus 25,000 plus 20,000. So total is 75,000. So we are giving 60,000, we are getting 75,000. That is why we should invest. Is this a correct thing to say? Is this a correct thing to say? That we are giving 60,000, we are getting 75,000. That is why it is better to invest. That is not correct, right? Why not correct? Why not correct? Because that 60,000 is today, and that 10, 20, 25, 20 is at different periods of time. So that is not comparable. If it is not comparable, then we have to make it comparable first. How do we make it comparable now? How do we make it comparable? So let's try to see this. Now understand this carefully. Okay. Understand this carefully. We can bring all the amounts to one time period, either to last year or to first year, anywhere, or year 0, year 2, year 3, anywhere. Let's correct. That is correct. 60,000 value will not be same after a few years, right? So let's try to do this. Understand carefully. We are getting 10,000 after 1 year. Let's try to discount this 10,000 to year 0. That is, we are discounting by how much time? We are discounting by how much time? 1 year. How do we discount? हमने अभी देखा ऊपर, we have just seen, we discount by dividing by 1 plus I raised to n. Our I is 10%. So 1.1 raised to 1. So discount the amount 10,000 divided by 1.1. Tell me if everyone is getting 9090.90 recurring. Let's round it off. Let's round it off to 9091. Correct. So if we discount it by 1 year, we are getting 9091 rupees. That means 10,000 after 1 year is equal to only 9,000 today. That is why we cannot just say that we will invest. We'll have to do this for every amount. Let's try to do it for every amount now. Every amount as in this now we'll have to discount by 2 years. How will we discount? Divided by 1.1 raised to 2. Discounted by 2 years. Then this by 3 years. This by 4 years. Do it by yourself. I'll also write the answers here without saying anything. You can round off. Second year amount is correct. These should be the amounts. I'll wait for a minute more. 18,783 is correct. 16, correct. Fine. I hope everyone has got these amounts. Very good. All are correct. Good. That means now understand we are paying 60,000 rupees. Pay. But we are not receiving that much. Let's see how much we are receiving. Can you take total of receipts? Take total of receipts today. Is it 58,063? That means we are paying 60,000 rupees. We are receiving 58,063 rupees only. So we are not in profit. We are in loss. Loss of how much? 1937 rupees negative. That is called as our net present value. Net present value. NPV is negative. NPV is negative. So should we invest in this offer? Should we invest in this offer? No. Right. Because we have to pay 60,000, we are getting 58,000. So we will not invest in this offer. That makes no sense. Correct. There is loss. We will not invest. NPV is negative. Okay. I guess there is some issue with this. Fine. So we will not invest. Okay. So NPV is what then? NPV can be defined as present value of inflows. Inflows means what? Whatever amount is coming in minus present value of outflows. Outflows means what? Whatever amount is going out. In our case, present value of inflows was 58,063. Present value of outflows was 60,000. That is why NPV was 1937 negative. That is why we decided no, will not invest. If NPV is positive, then we'll do what? We will invest. Fine. If NPV is negative, we will not invest. Can you tell me if NPV is 0, what will we do? If NPV is 0, what will we do? Will invest or not invest? If NPV is 0, what will we do? Will we invest or not? Again, the comments are lagging, so I'll wait for a minute so that comments come. फिर आगे जाते हैं. Then we'll proceed. Anyone's answer? For 0 NPV, what to do? Not invest, okay. Depends upon us, okay. Anyone else? No, okay. No, okay. Won't invest. Everyone is saying won't invest. Correct answer is no. Correct answer is we will invest. Okay. Why? Understand carefully. This question might come in theory type. Okay. We will invest. Why? Because 0 NPV means we are getting exactly 10% return. Okay. It does not depend on us. A 0 NPV means we are getting exactly 10% return. Understand? If NPV is negative, that means we are getting less than 10% return. That we don't want. So we'll reject the project. If NPV is more than, that is NPV is positive, then that means we are getting more than 10% return. That is better. So we will accept anyway. But if NPV is exactly 0, that means we are getting exactly 10% return. which is what we wanted. So if NPV is 0, we should accept the project, we should not reject it, and it does not depend on us, we should always accept. Okay, let me know if everyone has understood this concept. Okay, so if NPV is 0, we will accept the project. That is one of the important points to remember for NPV. So I hope this is clear. Okay, if clear, let's take one more quick question, then we can go to annuity. Let's take same question, concentrate carefully, but we'll do something else now. Year 0, 1, 2, 3, 4. Let's try to do something else now. Now this is very interesting. If you understand this, then you will never face issue in time value of money. Time value of money means you should be able to imagine what to take forward, what to take back. If you are able to imagine that, then ideally you will not face issue in time value of money. Understand? Let's take same example, 60,000 today, and then 10, 20, 25, 20. But now, instead of taking everything to year 1, year 0, instead of taking everything to today, let's do something else. Let's take everything to this year. So we'll have to do discounting or compounding. We are taking everything to year 4. So we are doing discounting or compounding. We are doing compounding, right? We are taking everything to future. So to compound, we'll have to multiply by 1.1 raised to n. Here only 1 year, so we'll multiply by 1.1 raised to n. Here we are taking forward by 2 years, so we'll multiply by 1.1 square. We are taking ahead by 3 years, so 1.1 cube and 1.1 raised to 4. Right? Year 4's amount 20,000, that will remain same because that is already in year 4. So we don't have to do anything for that. So take everything ahead and tell me what figures you get. Do compounding and tell me what figures you get. You should ideally get these figures. You can check once. Check once if you are getting these figures. If yes, let's again take total of receipts. These are our receipts. Receipts total is 20,000 plus 27,500 plus 24,200 plus 13,310. 85,010. Whereas payments are minus 87,846. That means we are getting loss of 2,836 loss. Right. If we want, we can call it net future value, but there is no such term. Okay. If we want, we can call it net future value, but ऐसा बोलते नहीं है. There is no such term. Right. Has everyone understood up to this point? Again, just let me know in comments because again comments are a bit behind. मुझे बाद में comments आ रहा है. Let me know. So still our decision will be what? Don't invest. Obviously decision should not change whether we take today's amount or 5 year after amount, 4 year after amount, right? Decision should not change. So still we are getting the answer as don't invest. Okay. Now understand very carefully. What was our NPV? NPV, that means year 0's net present value was how much? It was 1937 negative. -1937. So at year 0, we are getting 1937 negative NPV. Whereas at year 4 we are getting 2836 negative net value, right? Try to compound this by 4 years, still you will get same answer. Check. Try to compound this by 4 years, still you should get same answer. Compound means what? Into 1.1 raised to 4. Try to do it, check whether you get same answer. You get something like 2835.96 something, right? Which is same as this. So that is the relationship between present value and future value. Always remember, FV, future value, is PV into 1 plus I raised to n, whereas ulta PV is equal to FV upon 1 plus I raised to n. Let me know if everyone has understood this concept. Yes. This is the concept that any present value can be taken to future value by compounding, and future value can be brought to present by discounting. If you understand this, calculating annuity amounts will be very easier and faster, because now annuity we will be able to quickly convert everything from present to future, future to present. That is very important here. Fine. Okay then, next. Now let's go to annuity. Annuity, we have to see main 4 formulas. Annuity regular, annuity due. In regular, we have to see PV, we have to see FV. In due, we have to see PV, we have to see FV. So in annuity, we are going to see 4 main formulas which are very important. Understand very carefully. Good. Fine. Let's start with regular annuity first. Annuity regular. What is annuity first of all? In this question, bank was giving us some amount every year, annually. Annually, bank was giving us some amount, but that amount was not same. Every year they were giving us different amount. Okay, if every year's amount is same, then we call it as annuity. So annuity is what? Annuity is payment or receipt of equal amounts after equal intervals, or at equal intervals लिखना ज़्यादा better होगा, at equal intervals. That means rupees 10,000 every year, or rupees 5,000 every month, rupees 8,000 every 6 months. Equal amount and every equal in intervals. So equal amount after equal intervals is the feature of annuity. Then we can use annuity formulas. Then if we want, we can solve it like this also by calculating present value. But then we don't need to do it. If we have annuity, then we can directly use formulas for annuity. So let's see how to do that. Let's take an example and see through that. Let's say you have, or you will get rupees 10,000 every year for next 6 years. Interest rate is 12%. Find present value. Find present value. Now one thing that we can do is draw the diagram like this: 1, 2, 3, 4, 5, 6, and then take everything to year 0, and then take total as present value. But we'll not do that because now we have annuity. Understand how to calculate present value of annuity now. Formula for present value of annuity is present value of annuity regular. What is this regular? I'll tell you. First understand the concept, then I'll tell you what is regular. Formula for present value of annuity regular is A. A is annuity amount into 1 plus I raised to n minus 1 upon I into 1 plus I raised to n. Okay. Formula looks complicated, but it is not complicated. We are not going to use this formula on calculator. We are not going to use this formula on calculator. But understand it first. PVAR is present value of annuity regular. What is regular? I'll tell you. Wait. A is not amount, A is annuity amount. That is installments. Let me know if everyone is with me till this point. I is interest rate. Interest rate. And N is period. Fine. So let's see how to do that now. If we put it in the formula, if we put the given values, we are going to get 10,000 every year. That means that is our A. For 6 years, so that is our N. 12% is our I. So we can find PVAR, present value of annuity regular. That will be A into 1 plus I, 1 plus I raised to n minus 1 upon I into 1 plus I raised to n. Okay. But don't solve this. We are not going to solve like this. Okay, we are going to use a calculator shortcut. Understand, most important calculator shortcut. That formula of PVAR, we can write it as A into that. Let me write it again, 1 plus I raised to n minus 1 upon I into 1 plus I raised to n. This part will call as present value annuity factor. Present value annuity factor. And this factor can be calculated on calculator using what? How? Understand? On calculator we can find this factor as, take 1 divided by 1 plus I. 1 divided by 1 plus I. Then press equal to n times. Press equal to n times. And then press GT button. That will directly give you this present value annuity factor. Some people may not have GT button. That does not mean कि वो कर नहीं सकते. If you don't have GT button, then we can use something else. Understand? If GT button is not there, we can do 1 divided by 1 plus I. Then instead of pressing equal to n times, we will press equal to and m plus together n times. That means what? Equal to m plus, equal to m plus, equal to m plus n times. And then instead of GT, we will press MRC. Let's try to do it on calculator. Right now हमारे पास 1 divided by 1 plus I is 1.12. Then press equal to 6 times and then press GT. Check how much you are getting. No, GT, Varghese, GT means grand total. Okay. GT gives us grand total. Whenever, understand what GT button does is, whenever we press equal to, it goes into GT memory. Whenever we press equal to button, it goes into GT memory. If you have ever read ICAI guidelines, ICAI says that you can have calculator with 2 memories. Which 2 memories? One is m plus m minus memory and one is GT memory. So there are 2 memories of calculator. Some calculators don't have this button, that is okay, no issues. But it is just a bit faster. Try this. What are you getting? 1 divided by 1.12 equal to 6 times. Then GT 4.1114. Check how many of you are getting this. If you have m plus, still you should get same answer. 1 divided by 1.12. then equal to m plus 6 times, and then MRC, still you should get 4.1114. So that is our present value annuity factor. So we can just do 10,000 into 4.1114. 10,000 into 4.1114. That is how much? 41,114 rupees. 41,114 rupees. Best calculator. Ideally, stick with the calculator that you have. Don't change calculator at this stage. Do not change calculator 1 month before exam, otherwise you will get confused. Okay, it is best to stick with whatever calculator you have. You can tell me which calculator you have. I'll let you know if it is okay. So stick with calculator you have. Don't change calculator. According to me, I like this calculator the best. Okay, this one. You might have seen this, everyone, right? But some people have others. It is okay, no issues. Do not get calculators with tax plus tax minus buttons. Okay. Generally they don't check in exams, but if they check, then you might get in trouble, because institute allows only calculator with 6 functions. Okay, this is if tax plus tax minus is there, then 6 functions are not there, 8 functions are there. So don't use calculator with tax plus tax minus button. Generally they don't check it, but they might. Fine. So this is the answer. Let's try one more. First of all, tell me, is everyone clear with this? Correct. 41114 is the correct answer. Very good. Fine. Let's check one. Let's try one more. Before going to next, understand what is annuity regular. I wrote PVAR, right? What is annuity regular? Tell me, when I said you will get 10,000 every year, 10,000 every year, what did you assume? 10,000 every year starting from today, or 10,000 every year starting from end of the year? What did we assume here? This every year was starting from, correct, starting from end of the year, right? So when first payment is at the end of the year, that means it is annuity regular. If first payment is immediately today, that means it is annuity due. Okay, so annuity regular means first payment at year end or period end. Annuity due means first payment today. First payment today at year 0 today. So right now we are only dealing with regular, not due. Forget about due right now. Let's see one more question. So regular is first payment at end. Let's try one more question, and ये भी देखते हैं कि where this is useful now. Understand? Let's say you want to take loan of rupees 10 lakhs. Repayable in equal annual installments over 10 years. Interest rate is 6%, or let's say 9%. Interest rate is 9%. You have to find installment amount. You have to find installment amount. That is nothing but annuity. Every year, how much we should pay? That is what we have to find now. Have you understood the question? You want to take loan of 10 lakhs, and then we are going to repay it over 10 years at 9%. So how much should we repay every year so that loan is repaid? Let's try. Consider it carefully. Now 10 lakhs loan, we are going to take it today. That means that is our present value of annuity regular. Our present value is given as 10 lakhs because we are taking the loan today. Our annuity amount, that is installment, is unknown. We don't know that. We know I 9%, we know N 10 years. Let's try to use our formula. PVAR, that is 10 lakhs, is equal to A into factor. Let's try to find factor again. Once again I'll tell you, 1 divided by 1.09 then equal to 10 times and then GT, or equal to m plus 10 times and then MRC. So how much? 1 divided by 1.09, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 GT. That gives us 6.4176. Don't write it. I am writing it, you don't write it. Rutuja, you did opposite. Check once. This is our factor. Don't write it. You have it on calculator. Now we don't have to multiply it. We don't want to multiply it. We have to take it here as division. How do we divide? Add it to memory. Add it to m plus 10 lakhs divided by memory. That should give us 155820. Sanika, that is correct. Very good. This should be our amount. Or you can write it down and then do 10 lakhs divided by 6.4176. You'll get the answer. Fine. If you write it down, that is okay. But in this way, you will save some time. This is also 155820. That is okay. But in this way, you will save some time. Rutuja, you are multiplying it. You have to divide it, Rutuja. Understand? Okay, deleted the message. Fine. Is everyone clear with this? If yes, then for today let's stop here. Tomorrow we will see remaining 3 parts and we will try to end the chapter tomorrow. We'll try to end the chapter tomorrow. We'll take remaining 3 parts, that is FV of annuity regular, PV of annuity due and FV of annuity due. Then we'll make a big chart showing a relationship between everything. We'll take a big example where there will be multiple questions. Okay, and then we'll go to last few concepts of the chapter, perpetuity and CAGR and everything. Fine. Kavya nahi aaya? Try again. 6.4176 once you get 10 lakhs divided by that, right? Try it. If not, let me know. I'll help you definitely. Okay. Otherwise, if there is no other doubt, then let's stop for today. Chalo, bye everyone. Good night. See you tomorrow. Okay. So yes, chalo, bye. Clear. Good. Very good. Very good. Yes. Yes. Welcome. Bye.